Good afternoon, traders and investors. Will back here with another one, coming to you with a Friday market recap. Hope everybody had a beautiful day. And in today's markets, guys, unfortunately, we sold off all of yesterday's gains and more. The theme of the day is continued uncertainty. Uncertainty around two things. Number one, the escalating geopolitical tensions between Israel, Hamas, and Iran. Those hit news headlines this morning and caused some disruption in the markets. And number two, uncertainty factor remains heightened inflation and the timing and size of the interest rate decreases that will be coming over the course of the year. The market trying to digest all of this at the same time here, guys. However, we are in a big battle right now. Close to your all-time highs. It's a very heated battle right now between the bulls, who are favoring the soft landing scenario, the no recession scenario, and 3 rate cuts for the year coming as early as July, and the bear case scenario, which sees inflation on the rise, no interest rate cuts until at least November, and continued recession fears as potentially the economy and the jobs market may start coming undone over the course of the summer. So all of that is trying to be priced into the markets, and it's led to an increase in volatility over the past week that we have really not seen, guys, over the past year as a whole. Take a look at how volatile your markets have been ever since last Thursday, right? Massive drop last Thursday due to Federal Reserve Neil Kashkari's comments surrounding interest rate cuts, and there potentially being no cuts this year at all if the trend in inflation continues rising to the upside. And at the same time, this was your first time that geopolitical tension headlines actually caused some damage in the market when Joe Biden was speaking and basically gave an ultimatum to Israel to stop the conflict, allow assistance to for aid workers into the Gaza Strip, or else. And that was the first time, guys, that the markets really started paying attention to the conflict. The conflict's been going on pretty much since about the early stage of last October, and the markets, for the most part, have discounted most of those headlines in terms of that conflict. But now the markets are paying attention. In the last 6-7 months, that conflict is still not being resolved and is now hitting the boiling point. So now the rest of the world is definitely paying attention, and that has caused a significant increase in oil prices as well, which is also an indication, guys, that things are not doing too well in the Middle East. Supply chain disruptions are now front and center, back on the table as part of people's discussion. And also the VIX having one of its largest days of increases, guys, in the last 2 years, pretty much. The last time we had a 28% uptick on the VIX in one single day, you would have to go all the way back, guys, to April of 2022, pretty much. It's all the way back here. You can't see it. So just notable to us that there is such a big battle being had right now between the bulls and the bears. So in today's video, we're going to address some of those concerns. We're going to go over the headlines for the day. And then we're going to take a look at some of the bank earnings that came out that definitely did not help the situation either. And then we're going to cover our major technical analysis rundown in terms of our indexes and big tech names. And lastly, conclude with some subscriber requests. Now, Naveed has asked kindly to do BLBD, Bluebird stock, and Marvell. So we'll definitely get those in for you, Naveed, towards the end of the video. And James has requested for us to do Lululemon. So we'll tackle that as well towards the end of the video too. And then finally, we're going to look into my portfolio and see the trades that I concluded over the course of the week. So without further ado, guys, let's get into today's video. So SPY down 1.38%, QQQ down 1.59%, and all across the board was red. You really are not going to like to see the heat map, guys. Everything, really everything, except for Apple, pretty much coming down in the red as those fear catalysts just start mounting one on top of the other. Definitely not a great day on the whole. You can see here semiconductors pretty much are loss leaders for the day. Financials and healthcare continue their decline. JP Morgan here, 6.5% to the downside. Even though they beat earnings, guys, they had one of the worst days that they've had in the past year and a half. At this point, 2 years worth of days that we have not seen a decline like that in JP Morgan stock. The bank earnings, for the large part, were fairly decent, but just some very timid guidance for the rest of the year from a few of the CEOs of your major banks just led the entire sector to say no more, we're out, we're selling these things down. In terms of one-day relative performance, guys, you have pretty much red across the board, no secret there, led down by consumer cyclicals and technology, which brings our 1 week relative performance back down to red. Yesterday, it was fairly mixed, but now completely red as the bulls continue to lose ground and the red flags continue to mount. The sell-off pressures did not finish there, guys. Even crypto had one of its worst days in the last 6-7 months too. Take a look. Here is your crypto heat map. These are all your major players in crypto, and none of them are green. Most of them down by double-digit percentage points, if not 15-20% plus. Very negative day on crypto as a whole. And to just take a look at my lists here, guys, right? I have one list right here. This entire list is red, save for a few names which are barely break even. Even my value list, which is, usually fairly mixed, every single name except for a few outliers here, pretty much in the red, bright red at that point. So it just goes to show you guys, this was a fear-driven sell-off. People are exiting the markets. There was no rotation to be had in the markets today. So let's take a look at the headlines. Dow tumbles 475 points. S&P 500 suffers the worst day since January as inflation woes erupt. So let's take a look at the headlines at the article right here, guys. Stocks sold off Friday. Stocks sold off Friday as inflation and geopolitical worries once again dented investor sentiment on Wall Street. A broad decline in major bank shares also weighed on the market. Now, JP Morgan Chase shares declined more than 6% after the banking giant posted its first quarter results. The bank said net interest income, a key measure of what it makes through lending activities, could be a little short of what Wall Street analysts are expecting in 2024. CEO Jamie Dimon also warned about persistent inflationary pressures weighing on the economy. Wells Fargo slipped 0.8% after reporting its latest quarterly figures. Citigroup dropped more than 1% despite posting a revenue beat. Take a look at these bank earnings, guys. These bank earnings largely were fantastic, right? JP Morgan double beat in terms of that, and their guidance was relatively in line. The guidance really wasn't that soft at all. Citigroup, extremely bullish beat. They were not spared, 1.7% to the downside. A company like BlackRock had a great earnings, reported record assets under management. They had a double beat as well, still down 3% on the day. And the other one, guys, Wells Fargo Corporation, which had one of its best earnings in recent memory, double beat, decent guidance, still not enough for these markets, down 0.39%. So let's review further into the article here. Oil prices continued their rise on reports that Israel is preparing for a direct attack by Iran this weekend in what would be the biggest escalation of tensions in the region since the outbreak of the Israel-Hamas war last October. That, coupled with fresh U.S. imports data, added fuel to inflation concerns that have put pressure on the market. We're getting further risk-off sentiment heading into the weekend. You're seeing there's a flight to safety trade with the dollar stronger, and we're seeing equities sell off. So that is a quick recap of what happened in the markets today. And definitely not a great day at all, guys, but we have been talking about this now for a considerable amount of time. The apparition of a few red flags, and now over the past 2 weeks, we're getting even more red flags. Couple that with the fact, guys, we've been straight up for the past 4 or 5 months. And I'll tell you, the only thing that is saving these markets right now are the QQQs. Take a look at financials. Financials already losing ground, already in heavy weekly consolidation. Healthcare already in a weekly downtrend, significant declines. The only thing holding up your S&P 500 right now from significant weekly declines is big tech and semiconductors, guys, right? A lot of your big tech names and semiconductors just have not dropped a lot at all. Take a look, some of your market leaders, Amazon, still relatively close to all-time highs. Google, still relatively close to their all-time highs as well. Take a look at Meta. These are your lead market bulls, guys. The reason I'm bringing up is because if they start losing daily uptrends, watch out. SPY and QQQ are going to come down very aggressively. Meta, still close to its all-time highs. Microsoft, still close to its all-time highs. Even a company like Netflix very nicely on its 52-week highs, still off the all-time highs, but still no evidence of a correction yet. And even NVIDIA, guys, relatively still close to its all-time highs as well. I'm telling you, if the semiconductor market as well, and we'll take a look at this later on in the video here, semiconductors still close to their all-time high as a sector as a whole. That's why I say this entire movement, guys, is going to be predicated on is big tech going to act as a safety trade for these tensions that we have in the market right now and hold these markets up? Or are they going to join Team Bear and start declining as well, which could lead us into significant declines in the S&P and the QQQs? It will all be a case of earnings, right? Earnings are going to be the name of the game here, guys, over the month of April. What happened for this entire rally, right? This entire rally was predicated on a few things. Interest rate cuts over the course of this year, inflation coming persistently down, and companies after a, relatively bad 22 and 2023, cutting a lot of costs, trying to get their margins back up, trying to get that EPS back up, trying to grow revenue despite tough economic conditions, right? Well, 2024 was supposed to be the year of redemption for a lot of these companies. And so far it has been, but we've baked in a lot of expectations thus far, guys. And if your earnings cycles, you saw what happened with the banks this morning pretty much. The earnings were very, very good. But since they were not outstanding and since guidance was not outstanding, the market sold them off regardless. And that may be a case in point in what we're looking for this earnings cycle, guys. If you do not have continued outperformance, meaning better than expected revenues, better than expected EPS, and especially better than anticipated guidance, a lot of these stocks are just going to get hit to the downside because people are going to say a lot of those expectations were baked in to this move right here. And it's going to be very easy for them to sell down these markets and use all of that as an excuse to do it. All right. So keep very close attention to that. Now let's move into our technical analysis portion of the video, right? So SPY down 1.38% as a whole, still in the context right now, guys, of this daily downtrend that's plaguing the markets right now. We tried for the bounce yesterday, trying to set the higher low, right? Trying to regain control here. Unfortunately, just got the flush today. And now we are approaching the critical zone for SPY. Why? Because is your weekly higher lows, right? Beautiful weekly uptrend. If we lose those higher lows right here, it sets up the bears to set the lower high into lower low, weekly downtrend potential. That's why on Wednesday and Thursday, I was saying this market is beginning to look a lot like last October. 5 months of rally, and then you had some heightened inflation reports. The Fed became very hawkish, and the rest was pretty much history. You had a net sell-off in the markets, and now we're pretty much dealing with the same thing. Inflation upticking, the Fed potentially becoming more hawkish in the May meeting as they cannot anymore ignore the hotter than expected reads in January, February, and March. That's 3 in a row at this point. The Fed won't be able to ignore that. They'll have to say higher for longer and mean it, and Jerome Powell's probably not going to be as bullish this time. Couple that with geopolitical tensions, and you can definitely have the recipes, guys, for an extended little bit of a sell-off right here. That being said, the bulls still have not lost control. They only lose full control if we lose 505. So this is going to be the key level that I'm going to be watching over the next week and a half worth of trading, because now it's a bit of a discrepancy between your different timelines, right? On the daily, the bears are in full control at this point. We're below the moving averages, which shows that momentum is relatively weak as well. On the weekly, your MACD is now crossing to the downside as well. You can see that down here. RSI is crossing back down to more respectable levels, and we're coming in to the flush zone. So as of now, the bulls are in control, but what has to be said, guys, is they have to get their butts in gear quickly, or we may just lose the most important levels. And when you lose the weekly levels, guys, very rarely, especially in these market conditions, right? Everything's just not going to turn around on a dime. We'll have to digest the negativity for a while and then reprice everything. And then when people realize, once again, it's not as bad as we expected, and the market is still in the context of an overall monthly uptrend, just looking for the monthly higher low for further trend continuation. Once all of that fear gets priced into the markets and earnings are past us, thereafter, we're going to go back to business as usual. But for now, looking fairly dicey in the markets. Keep a close watch here. Once again, the bulls have not lost control yet on the SPY, but momentum is definitely not in the favor, and the red flags at this point are starting to mount up. So I remain cautiously optimistic, but I would not be surprised if the short term, as I've been saying the entire past month and a bit at this point, I would not be surprised if the markets take this opportunity to roll over and consolidate. It's a perfect opportunity for them to do so. There's not many positive news catalysts on the horizon, right? We have earnings cycles coming up. If those are anything other than outstanding, the market's probably not going to react too well to them because people are going to criticize the overextended valuations that we're having right now. We have geopolitical tensions. We have rates, right? Inflation on the uptick, rates higher for longer. All of that combined, guys, is just a recipe to provide a perfect cover for the markets to sell off until we get better news, right? Where else would the market sell off at this point? It's definitely not going to be start to sell off in May and June as we approach interest rates on the decline and as inflation numbers potentially get better, right? If it's going to do it, it's probably going to do it now, get it out of the way, rip the Band-Aid off, give us our correction, and then we can resume the bull market into the tail end of the year, which usually in election years especially is very, very good. So that is pretty much the gist of things where we sit right now. Now moving on to QQQ, guys. QQQ in the context right now still of this extended daily downtrend. We tried to get a bounce going yesterday. We tried to reset this into a daily uptrend. And so far, the bulls are protecting this on the QQQ. As I've said, guys, big tech has still not sold off yet. QQQ has remained one of your stronger sectors in terms of maintaining prior price action levels, but that could all change if ever earnings are bad or market sentiment continues to deteriorate over the next couple of weeks leading into those earnings. So everything is on big tech's shoulders right now. Will they be able to save the markets once again as they've had in the past, or will they too join the bears into an extended sell-off, into potentially weekly and monthly consolidation for April and maybe even a good part of the month of May, right? So keep an eye right here, guys. Close watch is going to be the low of Thursday, right? Now we're kind of trapped still within the range of Thursday's candle. So we haven't broken out of it to the upside, and we also haven't broke it to the downside. Now, whichever way this breaks gives some bulls, whichever way this breaks, guys, either sets the bulls in short-term control or the bears in short-term control. That should be fairly obvious. Your key structure levels right now, 447 to the upside, and to the downside, 435. If we come down too much into this area, guys, this is the flush zone right here. It is your weekly higher lows on the QQQs. Beautiful QQQ weekly uptrend at this point, right? Now we've been sideways consolidation. If you lose these lows right here, 433 weekly downtrend, they would join XLF in big weekly consolidation, XLV in a weekly downtrend. So far, QQQ is just muted sideways. So they are holding up the market very well right now, but remains to be seen which of these two levels will break first. If the markets continue to slide, I would not be surprised, guys, if big tech simply takes some risk off the table as well and goes into heavy consolidation mode, especially considering the fact that a lot of your big tech names are still at all-time highs and so far have not really been affected by the greater market sell-offs that we've been seeing over the past 2 weeks. So keep a very close eye on these levels right here. So far, very neutral on the daily. On the weekly, tightening range, bulls still in control for now until we lose this crucial area right here. And on the monthly, if ever we were to degrade and start losing levels on the weekly, guys, just keep in mind, even if we get an extended sell-off through our earnings season, through the month of May as well, as we start pricing in a lot of these red flags and current temporary fears, keyword temporary fears, we may just be due for some monthly consolidation in your QQQ before an extended considerable rally thereafter. Moving on to financials now. So financials, daily downtrend is clear as day right now. Financials, even though we've been having a terrible past week of trading, still not close to being oversold on the daily. On the 4-hour, we are approaching oversold, so we may just be due for a little bit of a bounce here, guys. But any bounce at this point, going to be looking for a lower high for continued lower low. The bears have put in a heck of a big leg right here. It's going to be very tough, guys, for the bulls to just V-shape this. In my mind, we are potentially heading for the lower high into lower low. Keep an eye on your moving averages right here. About $41 is going to be that mark. That's going to be major overhead resistance for the potential flush. We're now back under our big red box as well. This was previous all-time high resistance. We broke it briefly, and now we're back under it, so we're going to have to deal with that again. We're now beyond as well. We closed below the 12 EMA on the weekly as well, so financials turning the corner to the downside. Look at this MACD down here turning. It's just not giving us the best indication that financials are ready to rally back to the all-time highs. They may just be due, guys, for some more extended weekly consolidation. And that's the problem, guys, when you set so many weeks of up in a row without setting many big support levels on the way, you can lose these levels very, very quickly. The next big area of support sits right about here. $38.50 down to about $38 is the next big area of support for financials. And that's still a fair bit of ways away, right? Still a lot of drop to be had in financials. And that would represent a drop on financials of about, let's say, 7 to 9% top to bottom if that actually comes true. So we're going to keep an eye on this one day at a time. But you guys should notice something on this chart, right? 5 months, we didn't lose the moving averages and barely set daily downtrends in the process either. Now, severe daily downtrend, loss of your moving averages on the daily, loss of previous all-time highs, and on the weekly as well, your MACD is now starting to curl for the first time in 5 months. Not looking the best, guys. They are definitely one of your lead bears right now. Moving on to healthcare. Healthcare as well, one of your lead bears over the past couple of weeks, right? So as I was saying in yesterday's video and this week prior, financials, really, QQQ has been sideways, guys. For all intents and purposes, let's call it pretty much the last 2 months, right? Since February, not much price action. What has financials done in that same time since February, right? Huge upswing. Now we're getting the pullback. So financials did a lot of the heavy lifting for a long time. Healthcare as well. What have they been doing since February too? They did a lot of the heavy lifting before being sideways as well. Now both of these major sectors have joined the bears. In terms of your daily on healthcare right now, heavy daily downtrend. Actually, it looks something more like this. So at this point, guys, any bounce, and when the bounce comes, the bounce is always the same thing on any chart, any big tech name whatsoever. If you're in a daily downtrend, you're looking, when is this thing going to bottom out? Just look, when do the bulls recapture the hourly trend change? As soon as they recapture that hourly trend change, your daily bounce is underway. Then we look for the size of the bounce. As of now, the bears have put in such a hefty leg to the downside. I would not be surprised if we just get a lower high and then start revisiting these lows right here. So daily downtrend, well underway right now. Couple that with the fact that we're also in a weekly downtrend. So coming back to the daily here, guys, we've lost the moving averages. We're below those now, right? Healthcare was looking gorgeous this whole time and now looks a lot like it did last October when it really started losing these moving averages in a hard fashion, right? So not looking too good at all. We're coming up into a big area of support right now for the bulls, but the bulls so far not playing much defense at all. There's only a few levels left for them to start step in right now, right? So that comes all the way down to about 137.25, your last area of defense. We need to protect that level here, guys. It is pretty much the top end of the lower bound of this whole resistance area as a whole. So I need to see the bulls protect that. So far, top to bottom, healthcare is already down 6.5%. So the damage simply continues at this point. Keep an eye out down here, guys, because this level is a big one. This is your prior big weekly lows as well. On the monthly's not looking too bad here. Monthly just looking for a monthly higher low for further trend continuation, but healthcare, definitely some heavy sell pressure to the downside. Daily RSI is starting to get oversold, so maybe the bounce is coming soon. Look at the MACD as well. Another red flag curling to the downside, guys. We're only really waiting for SPY to cross on the MACD on the weekly. QQQ has recently crossed as well. All of your major indexes pretty much, except for, funny enough, except for financials, pretty much all of them at this point, guys, pointing to the downside, and that usually does not correct in the snap of a finger. Usually that means we're going for extended weekly consolidation. So the bears in full control now of financials and healthcare on the short term. The only thing saving this market, guys, is QQQ and this following sector right here, semiconductors. So semiconductors still 3% down on the day. Doesn't look like much because this is such a wide range of trade right now, but we've been keeping an eye on this level right here. Why is it so crucial? You see it best on the weekly. If we were to lose this level right here, 213, we would be setting up for a weekly downtrend. That would be the first weekly downtrend since last fall. Fitting enough, isn't it, right? So it's been a nice weekly uptrend this entire time, and now the bulls are starting to encounter a little bit of struggle. So keep a close eye on 213. It is the line in the sand for semiconductors. Obviously, if the bulls recapture this over the course of the next week, well, we need to break 229, 230 to the upside to really give us the best chance at getting a healthy daily uptrend going, mounting above this level and getting continuation and just perpetuating this weekly breakout to the upside as well. But as a whole, guys, it's just not looking the best for the overall markets. If semiconductors, one of your lead bull industries, starts falling apart, it's not going to be good at all, right? NVIDIA, one of your top names, still relatively close to the all-time highs. Another big player in the industry, ASML, still relatively close to its all-time highs. Another big player in the game, AVGO. These are all the ones that have very high weights in the semiconductors index. AVGO still relatively close to your all-time highs. They have not seen the sell-offs, the likes of which AMD and a company like Intel have seen so far. So if those lead bulls in semiconductors start taking a breather, watch out, guys. The entire index will pull back. They will join the bears, and QQQ will just have more and more pressure building on top of it, which could potentially flush some of these levels. So for now, the bulls still remain in control, but we keep on a cautious watch for the break of 213 over the course of the next week and a half. Moving on to IWM Russell now. IWM Russell definitely not having a good day either, 1.78% to the downside. The Russell, unfortunately, still just stuck in this daily downtrend right now. Daily downtrend simply continues at this point. At this point, guys, as soon as this dip finishes, just going to be looking for a lower high into continued lower lows until the bulls put in an engulfing enough bounce to reset this daily uptrend. But as a whole, guys, IWM, if the rest of the market continues selling off, you can't really be bullish on the Russell at all, can you, right? So not looking the best on the Russell in the short term. We are still now within the context of this overhead area, which was previous resistance. It is now acting as support for the bulls. But with this weekly close, we have now lost the weekly uptrend, right? So weekly uptrend was healthy as day. Now we have lost the most recent higher lows. So we've lost the weekly uptrend. It sets the bears up to put in the lower high into lower low consolidation, similar again to what we had last October pretty much, guys, right? When you saw a big engulfing move like this, lower high, lower low flush. If ever that happens, guys, well, we're going to keep an eye. 190 to about 185 becomes the next big area of contention for the bulls. It's the lower end of your support zone right here. It is the midpoint of this range where your 200 weekly moving average is sitting there as well. So a lot of trade to be had before we approach those levels, but still not looking the best for the Russell right now. The bulls playing somewhat good defense, but the overall markets are going to dictate where the Russell is going to go. You'll never see a day where the rest of the market is red and the Russell is just outperforming to the green days and days and days in a row. So this one is really beholden to the performance of the rest of the major players in the market. Now, lastly, the Dow Jones. Dow Jones, another one of your major indexes, guys, in a few notable downtrends right now. They have now lost clearly both of your moving averages, right? Daily downtrend confirmed right now. We're below your moving averages, and on the weekly, your MACD has crossed to the downside, which shows momentum right now is relatively bearish. We have also lost the weekly uptrend on the Dow Jones as well, losing these higher lows and closing below them over the course of this week. So your daily analysis remains the same as other indexes that are in daily downtrends. Any bounce at this point going to be looking for a lower high into lower low. Now the point, guys, we are now under our big previous area of support, which is that 38,600 level. We're below that. We also have overhead moving averages as resistance. So any bounce is going to be met by that resistance. And then we'll be looking, can the bulls save these lows, or will we just continue in this daily downtrend? In terms of the weekly as well, weekly flush of your lows right now, not looking the best at all, guys. The Dow Jones top to bottom is already in decent correction mode, almost down 5% from the tops. So at this point, guys, I would not be surprised if eventually when we do recapture this daily uptrend right here, right, we're going to be working that to the upside, but that may just be for a lower high into lower low. Keep an eye on this level, 38,500, guys. Your weekly 12 EMA is there. This horizontal line of previous support, which is now resistance, is there as well. Would not be surprised if we get something like this and head into further weekly downtrend territory, similar once again to last fall, which will just give us some healthy further monthly consolidation, maybe even back all the way to these previous all-time highs. That is 37,000 down to about 35.5. It is a wide range. I agree with you with that. And that will be a sell-off of between 7 and 10% for the Dow Jones, which would be huge, but that is pretty much what we had last fall sell-off as well. So not looking good, guys, across all your major indexes. The only one that hasn't given up the weekly so far is your S&P 500, and the large component of that, the reason that it hasn't given it up so far, is big tech, largely responsible for that, and semiconductors, which are also within the context of the QQQ trade too. So everything on the back of QQQ and SMH right now, a lot of pressure on these companies' shoulders. So earnings season is going to definitely be very, very spicy. Now, guys, let's get into some of your crypto analysis, because crypto also has taken quite a nosedive. So Bitcoin on the day down about 4.5%, but Bitcoin, although we had a relatively red day, we are still in the context of this overall tightening range. Keep a close watch on this level right here, 64,475. If we lose that, could set up for a daily downtrend and could also set up, guys, for a potential loss of the weekly. That would be a loss of 61,000. I know that that is still a significant ways away, but those are the areas that we're watching. If we lose the daily downtrend, your next reaction should be, where are we on the weekly? And that's why we target these levels on the weekly. All that being said, this area right here that we're in right now, right, 66 down to about 57,000 is a huge big area of previous all-time high resistance, should now be acting as healthy support for the bulls. So far, the Bitcoin bulls have not lost most of your major levels, right? Compare Bitcoin sell-off today and compare this weekly chart with other cryptocurrencies, majorly some of your other major altcoins, right? Big red flags in a lot of other names. Look at these sell-offs, guys, in a lot of your other major altcoin names, right? Just some extended sell-offs to the downside. I'll keep pulling up the charts just so you guys can see the stark contrast between what Bitcoin's doing and what the rest of the market is doing as a whole, right? So you can see that the Bitcoin sell-off is fairly muted. It's because they are still in a dominant position. The money is still not really rotated out of Bitcoin in favor of other coins. Have other coins ran significantly this market cycle? Yes, they absolutely have. But Bitcoin is still the king of the hill right now in terms of your dominance factor of this chart, right? So it just stands to argue that if Bitcoin starts losing more and more ground, your altcoins will have even more severe sell-offs as a whole. In my opinion, definitely a buying opportunity. Keep a close eye, guys. We have the halving event coming up on the 19th or 20th of April, pretty much. And usually in past years, that has been a sell-off and sell the news event. Now, 6 months, if you take in consideration the price action 6 months after the halving, it is 100% of the time positive, meaning we are going to be whatever price we are before the halving. Let's say we're 65, 60,000. 6 months after the halving, we are normally, well, not normally, we're 100% of the time higher than we were prior to the halving. And I firmly believe that, but it's anybody's guess what short-term price action will be. If the rest of the markets have a fear-driven sell-off here, guys, well, just take a look at what the markets pretty much did over the course of last October when we had the rest of the market selling off. You can see that crypto was not immune. Even crypto sold off as well as you had overall fear in the market. So just keep all of that in consideration. If we do start losing major levels, just looking for a monthly higher low on Bitcoin. All these dips are definitely for buying, guys. The end of 2024 and 2025, in my opinion, is going to be the bull market, the craziest bull market that a lot of you will ever see in your entire lives. There are going to be some numbers that crypto generate that are going to blow people's faces off. So just keep that in mind. I'm not even over exaggerating, guys. You know me, I'm a fairly level-headed person. I agree with you that 99% of all of crypto is indeed a Ponzi scheme. Almost a lot of it has no utility whatsoever, but it doesn't matter. Crypto is a game of narratives. It attracts a ton of money. I'm telling you guys, we will all be surprised at the levels that crypto gets to over the course of this bullish cycle. Moving on to Ethereum. Ethereum also looking fairly decent as well. Even though they had an 8.26% sell-off to the downside, we did not lose major structure level. That's why I say it looks pretty decent. If it came under these levels, guys, and closed below, well, that would not be looking decent at all. Still, 8.24% sell-off to the downside, right? Daily downtrend now started on Ethereum, so we have to take a look at our weekly levels. Weekly levels, the same ones I just pointed out on the daily. 3065 is your line in the sand level. Lose that, lose the weekly uptrend. We have not lost the weekly uptrend on Ethereum. Key point in time since last fall. How funny is that, right? So if we lose it this time, it will be notable to us. Weekly consolidation would just be met by monthly consolidation as well. And at least Ethereum, in the context of a gorgeous monthly uptrend right now, just going to be looking for a monthly higher low for further trend continuation. If we get back into these guys right here, call it about 2,800 down to about 2,500, that is a screaming buy opportunity over the next month and a half, if it does indeed happen on Ethereum. So as of now, the bulls still defending their last weekly area. Just keep an eye how we close this candle on Sunday night trading. That'll give us a better indication of what is going to transpire, either more weekly consolidation at this point through the month of April, through the halving event, and maybe early May. If that does happen, guys, I will be here buying all the crypto that you panic sell out of fear. Trust me. Now, moving on to our big tech names. So big tech, Apple, Apple, after being pretty much, there was so many days where this was the complete opposite, where we had an entirely green heat map, but Apple was the only red name. Well, now it's the complete opposite. The entire market's red and Apple still remains green. That was very funny to me today. So Apple up 0.86% to the upside. Apple, in the context of how the overall market is doing, is actually not positioned too bad at all. So you have this big engulfing move. We ran into a bit of resistance today, which was your 200-day moving average, this green line right here, and our overhead resistance, which starts at about 183, but 178, sorry, which goes about to about 180. So this whole area right here, 178 to 180, is the area that we're dealing with. You can see how much of a big chop zone it's been for the markets on Apple in the past as well. Support here now becoming resistance. So that's really the area that we're dealing with to the upside. Now, if the bulls lose this hourly trend over the course of the Monday and Tuesday session, we'll just be looking for a daily higher low. The bulls, thankfully, have put in so much space from these lows down here at 167.23 that the most likely scenario at this point is going to be for a higher low for a daily trend change attempt. We will see if the bulls can get it done. However, guys, this is not going to last forever. If over the course of the next week, we end up with many red days like this, Apple will get pulled down as well. No secret there either, right? At least we've created a ton of space. So we'll see, can the bulls set up for the daily trend change, or will they get dragged down too far and just reset into a daily downtrend and revisit these levels? We will keep a close eye on Apple's price action. It all depends on the size of this pullback, and obviously it all depends on the rest of the market too. But as of now, Apple not looking too bad. One thing is for sure, if in the next coming weeks, months, we get closer to these levels once again, 167, 165, that's where I like to be buying Apple myself. So all in all, Apple not looking too bad. Great recovery over the course of this week. Now moving on to AMD. AMD, however, not looking too good at all. So AMD finally breaking down into our area of support. We were kind of hovering above it now for the last 5 days. So a breakdown into this area was inevitable at this point. The bears wanted to test. Are the bulls going to support the price action down here? And so far over the course of the day, even though they were down 4.23%, it was tough for the bears to get much price action going to the downside after your initial drop on the morning, right? So the bulls have their work cut out for them. I'm not going to lie. Previous area of support, 164 down to 158. We're testing that now. It is a crucial area. Why? It's your previous area of support back here, January and February, previous all-time highs as well. And if you lose this, guys, well, you would be losing some significant levels right there, right? As of now, AMD, unfortunately, in the context of a weekly downtrend and in the course of monthly consolidation at this point, any move further down, even if we lose these levels, guys, just going to be for a higher low, anything above 94, looking for the monthly higher low for further trend continuation. The worst that AMD can get to, in my opinion, is about the 140 level. That will really come close to our previous 52-week highs here, this whole level right here, the 12 EMA, 140 down to 130. That is max pain for this drawdown cycle for AMD, in my opinion. The bulls have their work cut out for them, guys. If you want to see the bulls regain control, they need to bounce from this area expeditiously and bounce above our previous highs right here, 171.61. If we can do that, we engulf the most recent leg of selling, and then we can talk about resetting a daily uptrend and starting to recapture the upper bound of this whole very wide range that we've kind of been trapped in here for Jan and Feb, and now that we've been trapped in as well since the later half of the month of March too. So AMD not looking the best. If the bulls want to put in some moves, they have to get it done now. A big red flag would be next week, gap down below this level, and then this whole level starts acting as resistance, and that's when your extended sell-off most likely will take us down below into the lower 140 region. So we're going to monitor this one very, very closely. It's pretty much do or die for the bulls at this point to save a lot of prior weekly structure. Now moving on to Amazon. Amazon, give me a quick second. I think I moved my coffee breaks up from Google to Amazon. So maybe eventually we'll get all the way up to Apple and maybe even to Bitcoin, right? So Amazon, in the context of an overall red day, Amazon not doing too bad. Yes, it was down 1.54%, but we're still relatively close to the all-time highs, and bulls did not lose their structure so far. Now, in the context of this daily uptrend right now, so we're just looking for the daily higher low, anything above 182.65, just looking for a daily higher low for trend continuation if the markets rebound. If the markets continue selling off, guys, Amazon cannot do it all on its own. I understand it's very close to the all-time highs. I understand that the company is extremely bullish. Trust me, I'm most bullish on Amazon and Google for the entire year, so I know. But if ever we lose these levels, guys, lose the daily uptrend into daily downtrend, we look to our weekly line in the sand level, which is now going to be 178. The previous area that we broke out of, right? We're now sitting above it. We need that level to act as some support for us in the event of a multi-week sell-off leading into your earnings cycle, which is going to be Thursday, the 25th of April. I would like to see the bulls maintain the 178 even as low. I'll agree. If they can come down as low as about 175, that would not be too bad. And then we need to have some outstanding earnings from Amazon to really perpetuate this chart to the upside. So as of now, guys, Amazon not looking too bad. Any consolidation on the weekly, just going to be looking for a higher low. Anything above 172, going to be looking for a higher low. And then we get earnings, guys. Earnings is going to be crucial. If we come down to this level, guys, and for every which reason earnings are bad, which would be truly surprising, and we flush, well then, unfortunately, we'd be losing the weekly uptrend and would just be in for monthly consolidation. Anything above 118, healthy monthly higher low for Amazon for further trend continuation. So we'll tackle that once we get to it. But as of now, the bulls still maintaining full control across all of your timeframes, monthly, weekly, daily. Moving on to Google, another one of your lead bulls, guys. And this is why it's crucial. If your lead bulls in tech, I've said so many times in the video so far that your lead bulls remain semiconductors and big tech names. If some of the lead bulls of those sectors, right? So lead bulls in big tech, Amazon, Google, Meta, Microsoft, NVIDIA, if those start falling off and then semiconductors also fall off, the big ones, ASML, AVGO, TSM, NVIDIA, right? If they fall off as well, guys, everything's not going to be looking very good. Google as well. Google down about 1% on the day, but Google not looking too bad in the context of their most recent rally, right? So Google clear daily uptrend right now. It is clear as day. Any move lower at this point, guys, just going to be looking for a daily higher low. Anything above 151, looking for the daily higher low for further trend continuation. Now, you do have a somewhat of a weak low right here at about 156.32. Confluence of the moving averages. So if you're looking for the bulls to play defense, that is your first area of defense right there, where you would want to see a continuation to the upside thereafter. However, if we break down below this crucial level right there, the bulls will have lost too much ground, in my opinion, at that point. It sets up the bears for the lower high, lower low flush, and then we'll be looking, guys, to this most recent level, very crucial level, the 149, to act as pretty much a big line of defense. If ever we lose this key area of structure right here, guys, well, we'll be heading towards the lower 145s. We'll tackle that if we get there. That's still a significant ways away for Google, but just keep in mind, guys, the bulls have created a ton of space with this weekly move right here. Any move lower, going to be looking for a weekly higher low for further trend continuation. Google still looking excessively bullish, monthly looking bullish, weekly looking bullish, and the daily not looking too bad either. So Google still with a lot of ground to lose before we get any major red flags. But once again, start losing these daily uptrends in your lead bull names, and you will see, guys, the markets will start coming undone. The fear narratives will start resurfacing once again. If they're not already present, if you think that they're already present, guys, we probably haven't really seen the same fear catalyst that we had last October. Last October, you might remember, maybe you don't, people were panicking, like straight up panicking, because things have been down for 3 months at that point. You had a lot of big drops, not only in big tech, but a lot of other names too. And it was just panic, complete fear mode. So far, we have not entered that position just yet. So we need to keep a watch on these lead bull names. Moving on to Meta at this point. So Meta, not looking too bad either. However, we are coming up on a crucial, most recent higher low, 505.83. Lose that, you lose the daily uptrend. So Meta currently in a daily uptrend. We were looking for the daily higher low after pretty much rising yesterday, right? We were saying we're looking for the continuation of this daily uptrend. Oops, lower high. Now if we set the lower low, daily downtrend has started, and then we look to the weeklies. How much of this move on the weekly will we give back prior to your earnings? You need the bulls to create enough space and to keep the space above these levels, 490 to 480. It is your crucial weekly higher low region. And if we come down too close to there prior to the earnings, and then earnings, let's say, this could be a situation for most of big tech. We have good earnings, good guidance, but it's just not amazing, like outstandingly amazing. The markets just may react negatively to it. Everybody just may cry, well, it was priced in back here, and they may just send it for a little bit of a tumble. So far, that is not the likely scenario in my mind, as Meta has put in some very nice space between those levels, but come down too close into them over the next couple of weeks, and that narrative is definitely going to be on the table for a loss of the 490, 480. For now, still well in control. The weekly bulls still well in control of this gorgeous weekly uptrend as well, right? On the monthly still in control, but if you lose those levels, guys, monthly consolidation will be inevitable, even for one of your lead name bulls like Meta. Now moving on to Microsoft. Microsoft, not looking too bad despite its 1.5% sell-off. The reason I say it's not too bad because it's still within the context of this very wide range that we've been having pretty much over the past month at this point on Microsoft, right? So price action here, pretty much directionless at this point. The best we can do is say if we crack the 430 highs, well, your daily uptrend is clearly in motion at that point, and your weekly leg higher is now started as well. Microsoft in a gorgeous weekly uptrend currently. Move higher consolidation, move higher consolidation, move higher weekly bull flag. It is a bull flag because we've broken above the range, and so far in the last 3 weeks of sideways consolidation, we've maintained above the top end of our prior range right here at roughly the 415 mark. So not looking too bad on Microsoft. Where it would start looking a little bit dicey for Microsoft, in my opinion, as I've been saying in prior videos as well, is if we really start trending back within this tightening range, getting close to our earnings cycle, right? If we get close to earnings cycle and we're back within this range, it would lead Microsoft to potentially come close to the flush zone. If ever earnings are good, but not outstanding, people might once again cry, priced in, right? Everything's been priced in, and Wall Street may just decide to send this stock south 4 or 5%, and if we're all the way down here and get a 4 or 5% sell-off on Microsoft, that is what's going to break the camel's back, metaphorically speaking, right? But as of now, we're not there yet. The bulls still healthily in control. We're just giving these scenarios in the event that they manifest. You guys are prepared and you know what's on the horizon, right? Microsoft, for me, remains a buy at this point. Anything below 400, I'm looking for really 390, 380 myself on Microsoft. Not saying we're going to get there, just saying that that's where I'm personally looking if I want to initiate further positions on Microsoft. So as of now, your bulls still in control on the daily, not looking too bad. On the weekly, bulls still in full control. And on the monthly as well, bulls in full control. Any extended pullback, just looking for a monthly higher low for further trend increase later on in 2024. Now moving on to Netflix. So Netflix not looking too bad, down about 0.95% over the course of the day, right? And we are just going to be on the watch for these lows right here. 610 is a crucial level. If you lose 610, excuse me, I was on the 4-hour, guys, but the analysis is the same. If you lose this 610 level right here, daily downtrend has started right now. The bulls put in a tremendous engulfing move after this most recent leg of sell-off tremendous leg up. We were looking for daily uptrend continuation, or daily uptrend reset rather, and we just didn't get it. So now all eyes remain on these lows right here. The daily uptrend is still on the table, guys. If next week we just erase all the red, we can still get the daily uptrend follow through. But just a warning, if we break 610 to the downside, we'll be losing a couple things. Number one, we'll be well below our moving averages in the context of a daily downtrend. That has not happened since prior to last earnings in the month of January for Netflix, so it will be notable to us, and the daily downtrend there would mean extended weekly consolidation. Keep an eye on your weekly consolidation here, guys, leading into your earnings cycle. Gorgeous weekly uptrend as of now. Weekly levels are right here to maintain, but the true weekly higher low is right down here, 550. So if we lose these, it is a point in the favor of the bears, but we do technically have all the way down to about 550 to set a weekly higher low for further trend recapture potentially further on down the line. So just keep these levels in mind if we trend lower and lower leading into the earnings. Earnings for Netflix, keep in mind next Thursday coming up quickly. So I do believe price action will be fairly muted at that point, meaning probably not going to get significant breaks of these highs right here, and probably not going to break below our crucial level, which is 575, that prior resistance from 2020 and 2021. Probably not going to get all the way down there before earnings, even if the market has a considerable sell-off next week. That level is still a decent ways away, about 7% away. So all eyes will be on Netflix for next earnings, next Thursday on earnings. Now, moving on to NVIDIA. NVIDIA 2.68% of the downside. So NVIDIA still, guys, we are trying to reverse this daily downtrend. The bulls have put in a very nice engulfing move, recapturing 100% of this move right here, looking to set the higher low for a daily trend change. We will see, can the bulls get that daily trend change done over the course of next week? How do you know that they're trying to do it? Well, keep an eye, guys. Hourly trend is in the bulls' favor right now. We just need to recapture this. So far, the bears took back a lot of this move here today, but I'm not ruling the bulls out just yet. We can still do something like this Monday and Tuesday. So watch out for the break of yesterday's high 906. That would mean daily uptrend has been recaptured by your bulls. But to the downside levels here, guys, the downside needs to still be 850. If we lose 850, it is a crucial level of prior support, about a month in the making at this point. On the weekly, you can see on the weekly, guys, we've already been consolidating on the weekly sideways. So a break of 850, that key level right here would just extend us further into weekly consolidation. And then your levels become 800, this 12 EMA right here, and then 750. 750 is a crucial point in time as well. That was pretty much the break of this resistance after your prior earnings. So those become your lower levels of expectations for NVIDIA. If ever we do break down, as of now, the bulls are still in control of your short-term daily, right? Engulfing move, potential for the daily uptrend. They are still well in control of your weekly as well. This consolidation is fairly small as of now, right? In terms of percentage of the move, we've only really consolidated like 25% of the move, which is very, very bullish overall. And on the monthly still no monthly consolidation in sight. That all will happen, guys, in my opinion, whether or not 850 breaks. If 850 breaks, in my opinion, we are going to start retesting that 800, 750 level and head further into weekly consolidation. Keep in mind on weekly consolidation, guys, on NVIDIA, weekly consolidation on NVIDIA is healthy all the way down, 780, even all the way down to about 750 is still healthy. You wouldn't want to come much below 725, because if you come below 725, even if it's NVIDIA, guys, it becomes really tough to just V-shape this. Usually it would require somewhat of a two-step recovery process. So just keep that in mind and those levels in mind when looking at NVIDIA. I'm still so bullish on this company, guys. If I get a dip buying opportunity down here within the next month and a half, you're going to see me make a heck of a play on NVIDIA. Now, moving on to Tesla. Tesla down about 2% on the day. Tesla not being spared from the market sell-off over the course of the day, right? So Tesla really still trying to maintain this daily uptrend right now. We're going to keep a close eye here, guys, on this low down here. 161 is the line we cannot lose. So we're still trying to set the daily higher low for a potential daily trend continuation to the upside and get as much space as we can between us and this earnings release, which comes out the 23rd of April. As I was saying in yesterday's video, guys, if we want to be safe for earnings, I need to see the bulls get at least as high as about 190. If we can get to 190 with continuation of this daily uptrend until that time over the next week, week and a half, right, we would create a lot of space between us and the lows. If we get a high as about 190, we create about 15% worth of leeway between us and those lows, which I believe is what we need for Tesla. Last earnings were bad, and you guys can see we dropped about 12% after earnings. This earnings as well, we already got the deliveries numbers, guys. This earnings, I'm not expecting anything fantastic either. It's going to be a continued quarter of problems for Tesla. Lower prices across the board, which are going to impact margins, impact free cash flow, lower revenues from lower deliveries as well. We had some factory shutdowns as well as a byproduct of the conflict in the Middle East. Most noteworthy, that Berlin factory as well, right? CapEx has pretty much halted on the construction of the Mexico factory as the company is looking to hoard more and more cash. And just overall demand for the auto industry, guys, has been down. So there's so many negative catalysts potentially for earnings. I'll be very happy if they beat, and I'll be very happy if it's a bullish report. But guys, as the saying goes, hope for the best, but expect the worst. And in this one, unfortunately, I am expecting the worst. So we need to put as much space between us and those lows as possible before earnings, right? Because if the bears are to continue this weekly downtrend, at least they'd be starting it from 190. The bulls have a chance to save these lows right here. But if we're starting, right, if we come into earnings at the level we are right now, 165, 170, this is just a weekly bear flag, guys, and we're going to get weekly downtrend continuation, and we're going to probably retest these 150 levels. So the bulls have a lot of work to do to get ourselves some space between now and the earnings, right? Very, very, very crucial. Now moving on to Palantir. Palantir with a fairly muted day, guys, 0.74% to the downside here. Obviously, the price swings were fairly volatile on Palantir today, right? But over the course of the entire day, fairly muted as a whole, even though we got an extended hours sell-off as well. The reason I say it's not so bad and fairly muted, we're still within the past 2 weeks range of trading, right? Still dealing with overhead resistance clear as day right now. This yellow line, 2312, and your overhead moving averages acting as clear resistance right now. So if ever the markets continue their sell-off, well, this massive daily downtrend that the bulls tried to reverse down here but failed, this will just continue, unfortunately, guys, into an extended daily downtrend, into continued weekly downtrend as well. And then we would be approaching my buy territory, which I'm looking forward to, which would be looking for a monthly higher low on Palantir. Palantir is so much space, anything above 1550, looking for that monthly higher low. And we're coming down into my juicy spot, guys, 2150 down to about 19. Huge prior support, huge big resistance, and now should be acting as support as well. So I'm looking forward to these dips on Palantir, and I do believe Palantir is well positioned leading into these dips as well. The markets have been very, very volatile over the course of the week, and you can see Palantir really hasn't done this, has it? So it does have a lot of bullish support down here at these lower levels, and I do think that bullish support gets even bigger as we approach that $20 mark. So looking forward to that by Palantir. Obviously, if you want the bulls to reverse this, guys, well, we need a break of $24 to the upside. Break of 24 would really get the bulls back in the driver's seat, give them the capacity of breaking above this resistance and this resistance, right? This level right here, and the moving averages, and set us up for the daily higher low for further trend continuation, or trend change rather, and start putting a dent into this weekly downtrend as well. As of now, no signs of that just yet, so keep a very close eye on these overhead levels, on the 24 level for the break and the return of the bulls back in the driver's seat to the downside. Keep a close eye, guys, on the support. I want to get as low as possible in here. That's where I'm going to be buying, as close as possible to $20, $19 seems like a great area to me. Now, lastly, moving on to PayPal. So PayPal as well, down about 1.84% on the day. Not looking best on PayPal, right? Coming dangerously close to our daily higher lows. So quick reminder of what happened on PayPal. Daily uptrend was clear as day. We lost the higher lows. We lost the daily uptrend. The bulls recaptured it right away. And now we're kind of putting in an engulfing move, right? So now it sets the bears up for the lower high into lower low flush. And keep an eye, guys, if we get that flush, it will just be continued weekly consolidation on PayPal at this point. You can see now 2 red weeks in a row on PayPal. Weekly consolidation could bring us down into my sweet spot area, which is going to be 63 down to about $61. Your weekly moving averages are sitting there as well. So that seems to be a very juicy area of congestion for PayPal. And that would represent a very good sell-off, guys, from the highs, about down 10% from there. That is where I would start building a new position on PayPal myself. But we gotta watch out here, guys, because PayPal, if PayPal doesn't like one thing, is an overall market sell-off. Take a look at what happened for PayPal last fall. Was definitely not good. So I'm very cautious on this name right now. I think PayPal is really beholden to the performance of the rest of the market. It wants its recovery story so bad, but if the rest of the market sells off, guys, PayPal is just not going to be immune. We are currently in a technical breakout, meaning we are currently in a weekly uptrend. We're currently looking good on the monthly time frame as well, trying to put in a monthly uptrend as well. We are also well above our downtrending channel line, so we've broken above that as well. But all of that combined, guys, it's just a question of too little too late right now for PayPal. If the markets go into 3, 4, 5, 7, 8 weeks of extended sell-off, it's just too little too late for PayPal at this point, right? They didn't put in enough of a move over the course of this year so far to say that we are not going to come back into these lower levels if the market sells off. So just keep that in mind for PayPal. Very, very unfortunate for in that regard. Now, lastly, guys, that's pretty much everything we had for the stock market today. I spent a little bit more time as promised. The Friday recaps are going to be a bit longer as we, talk about stocks, talk about the indexes, talk about sentiment and the macro a bit more. So hopefully you enjoyed that. Now let's get into a few of our subscriber requests. So Naveed asking, can I please do BLBD and Marvell? So definitely, guys. So BLBD, this is a good one. I haven't looked at this one for a while, admittedly. But it is a very, very solid company. If you guys don't know what they do, well, they make school buses, right? The Bluebird school buses. That is indeed all that they do. And the company has benefited from a tremendous rally ever since the late month of October, pretty much. The company rallying to current price almost a 2x, guys, 100% to the upside. Very nice recovery for them. On the technicals, guys, this looks absolutely fantastic, right? Gorgeous monthly breakout. You could potentially be expecting a retest of these highs at some point in time. However, not likely, guys, and I'll explain why that is maybe not likely. That would be a sell-off of roughly about 28-30%. I'm not expecting that for the company because the fundamentals are just too good. So let's take a look at some of the fundamentals here on the company, guys. Fundamentals of this company, picture perfect in my opinion. Revenue growth through 2027, 12.5% per year. Look at this EPS growth, 43.5% this year. Most of your EPS growth comes in 2024, and thereafter it slows down to about 12.5%. That visually represented looks something like this. You can see huge increase in EPS into 2024, largely recovering their pandemic and post-pandemic years, right? Where obviously, the pandemic is a clear negative factor for a company who makes school buses with so many people taking classes from home, right? Demand for school buses just was not there. And the company just pulled back a lot of its production. And this is pretty much the point in time where I stopped looking at the company as a whole. But now they're well on the way to the recovery story. EPS expanding back again. Revenue as well, expanding back again. So the company now back on strong footing. And look at your analyst expectations, $38 all the way up to $44. Every single analyst extremely bullish. Take a look at the company's financials as well. Something else we look at, company now back free cash flow positive in 2023 and almost no debt. This company only has about $137 million worth of debt, and the company brings in terms of revenue, over pretty much $1 billion in revenue per year. Now, granted, their margins are not that high, but take a look at how much of free cash flow they're able to put aside last year, guys, largely able to cover now their cash and cash equivalents and last year's free cash flow. They can take care of a lot of that debt, so not too much debt for the company. Everything looking good. Now, in terms of valuation here, guys, right? EPS for 2024, we have that down. Take a look at some of your valuation metrics. So for 2024, their PE at $36, current price, about a 15, not too bad. The kicker is here. Look at this PEG ratio, guys. Only 0.34%. If you divide the PE by the EPS growth, only 0.34%. Now you may say, but Will, 2024 is an anomaly year. They gained most of their EPS in 2024. Thereafter, they're only growing at about 12.5%. Well, perfect. 12.5% is roughly, let's say, about 3.5 times. So if we were to multiply this PEG ratio by about 3.5 times, they'd only be sitting at about 1.1, 1.2, which is still very good. Between 1 and 2 is very, very, very healthy for any company here, guys. Very good. Now, the bottom line as well, in terms of valuation metrics is going to be price to sales. Price to sales is looking so juicy. The company brings in $1 billion of revenue last year, and look at their market cap. Market cap, $1.16 billion. Price to sales of pretty much 1. That is extremely good. So all of your fundamental valuation metrics, guys, are good. The company is moving in the right direction across all fronts. So if we're looking for some entries here, guys, this is just one of those stories that it's so hard. At Naveed, I thank you so much for bringing up the stocks that you bring up. You've brought up stocks like CLS as well. And a lot of these companies, guys, with great fundamentals that have run tremendously. There's only a few ways to play them, okay? And number one is going to be DCA. Obviously, it's so hard to buy a company up here for most people psychologically at least, right? But you just have to keep doing it. Who does this all the time? Which companies keep buying shares at the top of any given market, right? Which companies do it? Well, SPY, QQQ, all of your indexes. Which companies do they buy? They buy the best companies, even though they're at all-time highs, and keep buying into them regardless of your current market sentiment, right? So there's a big, I feel that a lot of people have a problem with buying things when they've ran a lot. Number one, valuation might be a concern. As of now, valuation is not a concern. But what you might see on the chart, the price action on the chart, you may think, I'm buying it too high up here. You're actually not really buying it too high up here. What can you potentially do? Dollar cost average is one way. You want to participate in the stock, but you don't want to full send the entire portfolio at these prices right here. Just wait, guys. It is in a healthy weekly uptrend right now. No fear of losing that. But if ever you see a little bit of a loss of the weekly uptrend, let's say the rest of the market pulls back, Bluebird will probably not be immune to this. Target this first level right here. 30 to 32 seems to be like a very solid entry level for any positions in time right now. Another option that you can do, guys, to kind of mitigate your risk at a certain point, if you don't want to go full exposure, well, you can always do leap in the money call options with 80 deltas. So currently, those are probably maybe the $30 strike, and you may be going out 1.5, 2 years out. It's a share replication strategy. We're not trying to speculate. Speculating would be out of the money calls all the way up here, $45, $50. No, what we're doing is in the money calls with the strike of $30 to $31. It requires less capital upfront and you get all of the share movement indeed. So that is one way of spending less money, but getting full exposure to a position that you're bullish on for the next 1.5 to 2 years, but you're just uncertain about the short-term direction of the price action. So that's just one way of playing it. But this company looks extremely solid. The bulls are in control of absolutely everything right now. As I said, right, if we are to continue this pullback a bit further, I would be looking for your stronger areas for the bulls to defend right here. 32, 31 seems to be like a very beautiful area. I'm really not sure, Naveed, if we get back to these all-time highs. If we do, perfect, but with these fundamentals and with the segment of the market that this company is in, right, it's more of a defensive play. Usually you don't get to see, especially when these companies are performing well to the standard that they are and expanding, you rarely see a sell-off of about 30%, right? That would only be in times where the overall market is really taking a dump or the company is just not living up to expectations. And that would be a period like during COVID, right? When you saw very big drops in EPS and relatively big drops in revenue as well. So far, that's not the case. So I don't believe you're going to get that massive of a sell-off unless the markets really take a little bit of a beating. Now, our second one for Naveen is Marvell. So Marvell has been one that I've looked at extensively. And just off the bat, I'll say that this is not my favorite semiconductor company. It's a good company, right? There's a few red flags for the company. It's just not my personal favorite one. Now, we did do some analysis on Marvell for you, Naveed. So let's take a look at that. In terms of your fundamentals, guys, really not that bad. Revenue growth of about 13% per year. EPS growth of about 20% per year. Really not that bad at all. Double digit growth across both segments. Now, take a look here. This is where it gets a little bit more choppy, right? And this is what they guided for on their earnings as well. 2024 EPS is going to be lower than expected. It is a transition year for the company. A lot of semiconductor names have said that is a transition year for them as they're looking to recuperate some of the demand, not for data centers, for a lot of other lines of business, guys, all right? So let's take a look here, guys. Some of their lines of business for Marvell, right? So you can see The data center business, just think NVIDIA, right? The data center business is what's been driving all of your semiconductor growth for the last 6 months at least. Now, data center revenue for the company has been expanding beautifully, but what have their other lines of business been doing? Absolutely nothing. Actually, they've been losing in terms of year-over-year percentage changes, right? This is a story that you see a lot in semiconductors right now, where the data center division is doing all of the heavy lifting for the rest of the company, which is why they say it's a bit of a transition year for them. You can see that best in the net drop in EPS over the course of this year before resuming 2025 and 2026. And even revenue, guys, is going to be slightly down in 2024 and expanding thereafter in 25 and 2026. All of that being said, it gives them the following valuation, right? So if we were to take the 2024 forward PE at $70 right now, 49, their PEG ratio about a 2.46. Not the best, I will give that to you, but that is considering that 2024 is going to be a down year for EPS. If we were to just remove 2024 and look at this company from what they're giving in terms of perspective for 2025 moving forward, which is their best years, right? Well, we get much significantly better financial ratios here because your EPS growth 2025 to 2027 comes closer to 50%, which is a net bump, right? That gives us a forward PE of about 28.5 and a forward PEG in 2025, so after 2024, of 0.57. So if you're looking for this company at 2025 and 2026 cash flow prices, then at $70, it's a relatively good deal. But over the course of the next year, which is a very important year, this company is not valued the best in terms of them all, which is why it's just not my favorite company for the time being. For a long-term portfolio, it's a decent play, I assume. Still not one of my favorites as a whole, guys. But in terms of that is just how the numbers are broken down. Now, in terms of your technical analysis, guys, we are still in a monthly uptrend right now, still just hunting for that monthly higher low. Very good support right down here at about the $65 range. And you can see that even best once expressed on the weekly, right? Huge prior weekly resistance right here should now be acting as big weekly support as well. This one is not going to be spared if the rest of the semiconductor market does fall apart. So buy levels potentially, guys, if we do come down below 65, start getting into some oversold conditions perhaps on the RSI, could be a juicy area in the lower $60 range to make an attempt at the monthly higher low for potential trend continuation to the upside over the later part of the year. But this is just not my favorite company for a few reasons. Number one, guys, well, because of that, the inconsistency in EPS and revenue over the course of the next year, but also because the company has 64% gross margins and can't bring any of that to the bottom line over the past 4 years. They have severe problems of cost control. Most of their money gets spent on research and development. I'll give it to them. They're a technology company. They need it. But the fact that they are not able to bring in positive net income is a problem, guys. When the rest of all the large players in this business bring in positive net income and you're not, you become the outlier. And that's why I do not like this company. Some of its closest competitors, the likes of which like NXPI is now positive net margins, right? A few other companies, the ones off the top of my head, I think Analog Devices also does something similar to them, right? ADI does something specifically similar to them. They don't manufacture semiconductors. They just manufacture everything around the semiconductors industry. Even a company like this, positive net margins as well. There's just so many other companies to choose from, guys. My favorite companies, you got to go with the best of the best in semiconductors, guys. There's so many different companies to choose from. In my opinion, there's only a few that are worth holding for the long term. You have to go with the best of the best. The best of the best are NVIDIA for the data center business. NVIDIA still goes to outperform, but that's no secret. You guys all know about NVIDIA. The other one is obviously going to be ASML. ASML manufactures the machines that China cannot get their hands on. They manufacture the machines that are required to build the best semiconductors in the world. And those machines cost $200 million and they're in high demand. They have backlog orders for the next 2.5 years. This company performs extremely well and they have positive, profitable net margins. And they're currently well above their all-time highs, just looking for the breakout retest trade. This is one of your more favorable names of the spaces. You got to go with the big boys if you're playing semiconductors. The other one, if you want these actual chip plays, is TSM, the market leader, right? And the market leader, even with their price appreciation, their PEG ratio is very, very good, even compared with Marvell, industry leader. And lo and behold, they have extremely good positive net margins. And they don't have the fluctuations that Marvell is having currently. You can see that their APS are just going netly higher. So in my opinion, Marvell is not the best. Semiconductors, you need to be playing the best of the best. All the other ones are just benefiting from what the best of the best are doing. The other ones are not the cause of the semiconductor rally. They're just benefiting. It's rising, a rising tide lifts all ships type of scenario, right? Another play, if you don't want these companies, if you want to go with something, you may be able to go with the index as a whole, semiconductors, the SMH index as a whole on somewhat of a juicy dip. But then you may say, but Will, an ETF is boring. I want some outperformance, right? The ETF may only go up 20%. I want something that goes up 50%. Well, just remember those leap call options. If you're bullish on semiconductors, which you should be through 2025 and 2026, consider 1.5 to 2 year in the money leap call options. 80 delta should be the strike that you're targeting. That should roughly be around the 190 level. So if you get a big dip down here in semiconductors down to about 210, that would be a great time to shop for some in the money leap options. 190, 180, 1.5, 2 years out. You get the benefit of being in the ETF, but you get the leverage of having options, and that will usually perform, especially if it's a leap option, 80 delta, they usually perform 2-3x versus the underlying, right? So that could also be a good play. If you're confused between all these different semiconductor names, well, that may just be a specific play that you can take. It offers you good leverage, and at least you're not going with something like SOXL, right? Which is your 3 times levered ETF as a whole. These ETFs can sometimes be a little bit dubious to trade. Keep an eye on this, right? The 3 times leveraged ETF, still not back to the all-time highs, even though your underlying is well above your all-time highs, right? So you got to be careful with these. These are really good to be buying on heavy dips during market corrections like last fall, but you have to wait for them. You have to be patient for them, right? Which is not the same thing that you would be doing with in the money leaps. In the money leaps, even if the market continues dropping, guys, right? You're exposed to the underlying. You're exposed to SMH. So that one at least should not be dropping more than roughly about 10%, right? So just keep an eye. Those are the things that I'm going to be looking out for semiconductor plays. Now let's head into the Lululemon technicals for James. So James, let's look into Lululemon. Lululemon, I actually covered this one after their earnings. So if you haven't seen their earnings that I covered, James, I'll link it down below in the video description, right? So currently, Lululemon obviously facing increased competition. That was the gist of things from their earnings, right? They are nervous because of all the increased competition that's currently happening, and a lot of organic brands are sprouting from TikTok, from Instagram, doing viral marketing. And the things that those stores don't have is a lot of overhead, right? Lululemon has a lot of overhead because they have a lot of brick and mortar stores, which tend to erode profit margins. And that's kind of what we saw over the course of the last quarter. That was the concern for guidance over the course of this year. Will foot traffic in their stores improve? And the guidance was a bit light on that, which is why we've been seeing an extended sell-off on Lululemon. So for a full breakdown of their fundamentals, I've already done them. So just take a look at the link down in the description. Not only James, but anyone who's interested. In terms of technicals, guys, obviously it's not looking too bright right now, is it? So weekly, obviously full bear control right now. Weekly downtrend clear as day. Getting oversold on the weekly. When is the last time we've been oversold on the weekly? There was one time back here in Jan of 2022, after which few more weeks of consolidation, we did get a significant bounce. When was prior to that? You would have to go all the way back to COVID to get levels of this sold off on the weekly. Obviously had a nice bounce after that. And prior to that, you would have to go back to when the company was still super small. It was not the Lululemon as it was today. So I don't even kind of want to compare it to what it was back in 2017. But that was the last point in time. And after some extended sell-off down here, in 2017, you can see that when we did get to daily oversold levels, it did hesitate for a few more weeks, final flush, and then we did get an extended rally. So as a whole, guys, we are probably approaching the bottoming process for Lululemon. That being said, it's a falling knife. Let's just call it for what it is right now, right? Complete falling knife, daily downtrend clear as day, no sign of bull support in sight. Eventually, you'll need to see the bulls put in a move and then start retesting the daily to form a daily uptrend. I would not personally be considering a position in Lululemon right now until I see a good enough, a sizable enough engulfing move, and then I'll be trying. When we get consolidation, that is when I'll be trying. I'll be looking at the hourly and trying to make a play on some higher lows for a daily trend change. That's the only time I'll be looking to play Lululemon, currently in a falling knife territory, which is why I highlighted this area in green. We've only got so much to go. You can see we've just now crossed our 200 daily moving average. We only did that a few times back here in 2022. For the most part, Lululemon has maintained the 200 weekly. And we're also coming up in this big area of congestion, this big green box that I've highlighted. Truly, if you want to remove the spikes down of price action in the worst periods of all of those markets, truly we're only looking at between 325 to about 300, let's call it. That is most likely where the bulls will put up a very big defense and where we could be potentially looking for Lululemon to establish somewhat of a bottom and start recapturing the levels. But as a whole, guys, Lululemon, once again, I'll remind you, part of the consumer discretionary trade. And what niche is those trades in right now, right? They are in our unpopular high-risk trades, consumer discretionary. People may not have as much money as they did to go out and spend money on Lululemon. Now, Lululemon obviously has somewhat of a benefit. It does have a lot of their customers that are part of the luxury segment, right? The rich people segment that just continue spending throughout a downturn in these consumer cyclicals. But there's also a very large part of Lululemon's business, which is just the average person, right? I wouldn't say that Lululemon is Louis Vuitton, right, at this point. So Lululemon's still exposed to consumer discretionary, and you need look no further than stocks like Nike, stocks like Starbucks, right? Stocks like Starbucks right here. And even some of your other names like Walmart, right? Walmart, even though Walmart has been doing very good, they did guide a bit lower for this consumer discretionary spend. A lot of their sales are coming from essentials. Now, the market hasn't beaten them down as much, but just goes to show, guys, I remember their guidance for consumer discretionary, and it was not the best. And the list just continues, guys. You know, consumer discretionary is just an unfavorable trade right now. If you're looking to build a long-term position, fine. But short-term, guys, a little bit dicey, right? So that's pretty much everything that I had for you guys today. Probably save the portfolio update since we're now about an hour and 20 minutes into this video. Probably save the portfolio update till tomorrow. And tomorrow, we're also going to be doing a video on the earnings recap for your bank earnings that happened today. So I'll try to include all that in tomorrow's video. If not, this one's going to be way too long. So I apologize for the length of the video, guys. Really wanted to cover everything in depth because we're dealing with everything at such critical points right now. So hopefully everything was insightful for you guys. Right? As a whole, if you did like the video, consider dropping a like. Would really appreciate it for the growth of the channel. If you're new to the channel, consider subscribing. We would love to have you here. And as a whole, guys, if you have any questions, always feel free to leave them down below in the comments, and it will be my pleasure to answer you, usually within the first 24 hours. So take care. I'll see you. Have 2 videos coming this weekend. One tomorrow for financial earnings and my portfolio recap, and then the second one on Sunday for the top 5 options plays going into next week. So take care, guys. See you over the weekend, and peace.